Welcome to Catalyst. I'm Seana Smith alongside Madison Mills. We're 30 minutes into the U.S. trading day. Let's get into three catalysts that we're watching this hour.
First up, a risk-off shift in the market as the 10-year yield hits a low for the year and the tech-heavy Nasdaq continues to fall.
Plus, the latest consumer confidence data crossing the wire, what the numbers tell us about inflation expectations.
And Bitcoin sinking to a 3-month low. We will unpack what's driving those declines right here on Catalysts. We're getting a preliminary reading on consumer confidence in February, dropping sharply here. You've got the survey anticipating 102, but the number coming in stiffly below that at 98.3 and also below the prior reading of 104.1 here. So interesting to see that level of a decline here. Again, that consumer confidence number coming in below the survey number, which was 102. The actual number coming in at 98. Conference board expectations also falling, coming in at 72.9. So we're going to continue to break down those numbers as we get them here. Joining us now, we've got Yelena Shaletyeva, the Conference Board's senior U.S. economist. Yelena, I'm still waiting for all of the data to drop in, but what else can you tell us?
Well, I think it was a sharp drop, no doubt about that. And now the index is at the lowest level of the range it has been hovering over the last several years. Having said that, I think the index is still within the range, which is associated with healthy consumer spending. Although the decline in expectations is definitely a concern and deserves a close watching.
When you say it's a concern, I guess at what point should we be a bit more worried? And what is that range that would then drop below that we would then, I guess, would raise some of those concerns?
I think this particular survey from the Conference Board is telling us a lot about the state of the labor market. Mm-hmm. And this particular decline in the confidence indicator was driven by consumers' expectations for business conditions and the labor market. Mm-hmm. So what is a concern is that consumers are not seeing great prospects in the labor market, and that is something to watch in the months ahead. If that continues to deteriorate, that's a big deal.
But it also looks like inflation expectations ticked up. Median inflation expectations coming in at 4.8%, following 4.2% the prior month. How concerning is that?
Consumers are worried about inflation. Inflation is sticky, and the latest developments in terms of, I would even say some certain consumer goods such as eggs, that could be driving it, and also the talk about tariffs. So we know that next week, the next round of tariffs is probably going into effect, and consumers hear this news and they are very concerned about this. So everybody is talking about inflation rising on the back of tariffs, and that is a great concern for the consumer.
Yeah, I'm taking a look at this release here. It looks like that the decline was across all age groups, also was pretty broad-based among income groups. What's your takeaway from that, just the fact that we are seeing some of that concern really just across the board?
That is a concern. We know that consumer spending has been in a large part driven by those at the top of the income spectrum. So those more affluent consumers who have assets on their hands, they are, they hold stocks, they have property, real estate property, they have been driving consumer spending. But the fact that it's a decline across the income spectrum and age groups is a concern, because that's our consumer spending, and if this is going to slow down significantly, that's a concern for the economy.
It's interesting, though, in this note, in the survey data here, looking at a 6-month average basis, purchasing plans for homes continued to recover. I wouldn't have expected that based on what you just said, that all income groups are feeling a little bit more negatively about the economy. Where is that recovery in housing coming from?
I don't expect the recovery in housing this year. Rates are still elevated. The affordability is still pretty low given where the prices are. We actually have a drawback from the residential investment sector in our projections for the economy for this year. So I think, until we see a more significant decline in long-term rates or, like deceleration in price increases for housing, we will probably not see a significant improvement in the sector.
What are you hearing just in terms of the fact that we could be in this high for longer environment and how much pressure that could potentially put not only on the sentiment side of things, but obviously that hard data too?
So I think, what we expect for the economy is deceleration this year. So we are coming from this high growth that we saw post-pandemic. So that process is continuing. So we saw some pickup in consumer spending over the turn of the year, and probably that was driven by consumers trying to stock up ahead of tariffs, and businesses too. Now that that has already happened, I think we were going to continue to slow down towards the end of the year. My concern is the labor market. If it slows down significantly, that would pull things quite significantly below what we expect.
So how are you thinking about the divergent policy impact on the labor market? Obviously, we're seeing cost cutting leading to a lot of layoffs for federal workers, but then you have news like Apple adding 20,000 jobs to the U.S. Do you think that these U.S. companies adding jobs could offset some of those concerns?
For now, we're at a very happy equilibrium, right? So we're not adding too many jobs, but we're also not cutting. There are no layoffs. So it could go either way, right? Depending on how businesses are feeling. So we had another survey earlier last week that showed business optimism was rising quite significantly. So which way will it go? We don't really know. And for now, businesses feel optimistic, and they are expected to hire people. But at the same time, if tariffs have a significant impact on economic growth and our expectations that it could potentially cut up to 1 percentage points from growth this year, if what has been announced is implemented, then we're probably going to have a different story.
All right, Yelena, great to have you. Thanks so much for joining us.
My pleasure.
Let's take a look at a trending ticker here this morning, and that is Home Depot, the company issuing a conservative same-store sales forecast for the year as it expects consumers could potentially hold off on some of those larger purchases. But the focus on the street, the reason why we're seeing the stock up nearly 3% here in early trading, much of that has to do with the stronger than expected quarter, the fact that same-store sales did snap 8 consecutive quarters of declines, actually rising 0.8% from a year ago. Joining us now to discuss is Michael Baker. He's D.A. Davidson's senior research analyst. Michael, it looks like the street, at least looking at the more optimistic side of this report. I think the big question is whether or not some of the improvement that we saw in same-store sales, whether or not there's enough momentum for that to continue. What do you think?
Yeah, I think the strength in the fourth quarter is really what is carrying the day here. The 2025 outlook was below consensus, particularly on the earnings side, a little bit more so than on the sales side. Both were below, but I think the real pressure point was the earnings. But it's pretty clear, I think, from the call and from what we know about retailers in general, that companies want to sort of set a lower bar. That doesn't mean they're sandbagging it. January was a softer month than December, so they did see a little bit of a slowdown. That plays into the guidance. But I think the bigger idea is let's just set a low bar, something that we're comfortable with, given all the uncertainty in the environment, all the policy rifts, as we call them, our acronym, for rates, inflation, FX, and tariffs. It makes sense to set a low bar. But clearly the business seems to have bottomed, given what we saw in the fourth quarter in a number of metrics the company talked about on the call. Big ticket spending, et cetera.
Well, it's interesting, though, because the CFO did mention that they're still facing pressure as customers adjust to high interest rates. How concerned are you about the headwind that could present, especially if the Fed does not continue to cut rates?
Sure, that's a pressure point, but it's a pressure point that's not getting any worse, right? We've been dealing with that for quite some time. In fact, rates don't seem to be going up anymore. They're down 30 basis points or so on the 10-year in the last month. Home Depot gives a metric on comp sales for tickets $1,000 or higher. That was positive this quarter. That's the first time that's been positive for more than 2 years. It had been down 5-6% every quarter. So there's still some pressure on these interest rate sensitive businesses, but again, no worse so than it has been, and maybe even getting a little bit less worse.
Michael, one of the questions going into this report was the impact of tariffs and the threat of tariffs, maybe what that could do ultimately to Home Depot's business in the longer term. Where do you stand on that, just the broader implications of it?
Yeah, to me, tariffs are a relative game, right? It's all a function on how much of your COGS come from overseas, and then your ability to push back on vendors or pass through to consumers. And we think within that sort of dynamic, Home Depot is pretty well positioned, particularly as it relates to pushing back on vendors. That's all about scale. Home Depot pushes a big pencil. Their vendors want to keep that Home Depot business. That doesn't mean the vendors will eat it all and Home Depot won't absorb any. But within that sort of negotiation dynamic, Home Depot is pretty well positioned in our mind.
So it doesn't sound like it's too big of a concern, but I guess how big of an impact is it going to have on their business?
Well, again, if anything, we think it'll tend to be maybe slightly positive because we do think they'll be able to pass some of it through to consumers. That's what we saw last time there were tariffs in 2018-19. So maybe even a little bit of a comp benefit. Now the offset could be, do you lose units? But that's not really what we saw last time. So listen, we don't want to dismiss it. We do think it could have some impact, but they will be, particularly on the margin side, but they will be impacted less than others. And again, it could actually be a helpful item to the comp line.
One of the concerns from a macro level is this idea of a K-shaped recovery and that lower income consumers will potentially be more negatively impacted by the policy shifts of things like tariffs versus higher income consumers that have a little bit more on their balance sheet to protect them from any inflationary pressures. How does a company like Home Depot potentially get impacted by a K-shaped recovery if we do start to see those middle and lower income consumers struggling even more?
Yeah, Home Depot does skew more towards higher household income customers just by virtue of the fact that you're a homeowner. So that kind of dynamic, while unfortunate for the lower end customers, it really does play well for Home Depot, which again, more of their customers are in that middle to higher income demographic.
Michael, who's best positioned within this coverage space right now to you here over the next couple of quarters?
Well, we like Walmart, particularly on the pullback after last week's report. We like other discounters like BJ's and Costco, but BJ's better just given the lower valuation. When I say other discounters, we don't love the dollar stores, but BJ's and Walmart within the discount space. And then I think there's an opportunity here at Home Depot. We upgraded it last year. We knew we'd be a little bit early as it relates to the housing recovery, but housing's not getting worse here. In fact, existing home sales have been up on a year-over-year basis 4 months in a row. So again, we think we're in front of the recovery, but that's really when you want to buy stocks in front of the recovery. So we think we're there now.
All right, Michael, always great to talk to you. Thanks so much for hopping on with us here today.
Sure.
Coming up, we're going to take a closer look at some of this morning's trending tickers, including why shares of Supermicro are off just about 8% right now. We'll be right back. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up, shares of Japanese trading houses rallying following Warren Buffett's plans to increase its holdings in 5 Japanese trading houses. Now, Buffett praised Japan's trading firms for their business practices, including increasing dividends, conducting share buybacks. He also said that his holdings of the 5 companies are for the very long term. Looking at the reaction here in the stocks today, the market was closed overseas yesterday because of a holiday. So we're seeing that play out from the news that we got over the weekend here this morning. Now, when it comes to the opportunity here that he does see in some of these names, especially in Mitsubishi, we know that Buffett first showed interest in them back in July of 2019, but he has been very consistent just in terms of his praise. This is very much a follow through of some of that rhetoric here that we have heard over the last several years.
Yeah, and it's played out in the ADRs here. If we can take a look at the performance of these trading houses versus the index over in Japan, the Nikkei 25 here, you can see the outperformance of all of these trading houses versus the Nikkei, which is going to be the bottom line on your screen there. So clearly a successful bet for Warren Buffett so far. It was also interesting in that Berkshire annual letter. He talked about how these trading houses did agree to relax the ceiling on Berkshire holdings, which had been at 10%. They're relaxing that, so they're going to be able to own a little bit more. I wasn't able to see clarification on exactly how much more they're they're interested in moving forward. But lastly, I'll just add, I thought it was interesting the specific pros that Buffett put forward for these trading houses. He talked about how he likes their dividends, they conduct share buybacks when it is sensible, and he also liked that they are not as aggressive in their executive pay as U.S. companies are, which I thought was interesting, a little bit of shade thrown towards the U.S. companies that are maybe overpaying their executives.
Yeah, what was also interesting was just some of the commentary just surrounding currencies, right? And just in terms of the fact that he was, once again, just very confident in their yen balance strategy, what he described as a yen balance strategy. He also went on to say that that he and Greg both have no view on future FX rates here, and therefore do seek a position that's approximately currency neutrality here. So again, I think that's important to keep in mind, especially when you go back to some of the volatility that we saw over this past summer.
Yeah, really great point, Seana. All right, well, we are also going to talk about shares of Supermicro falling ahead of its deadline for already delayed financial results. In an earlier update this month, Supermicro had said that it did expect to meet today's deadline. If the company does not deliver, though, it risks being delisted from the Nasdaq. So let's just do a little rewind in time. Remember, Supermicro, they delayed their financials for the fiscal year ending in June 30th. They delayed that to September 30th, and now they've delayed it again, and the deadline is finally here. If they do not comply again, they could be at risk of being delisted from the Nasdaq. It was the most volatile stock in the S&P 500 last year, in part due to these concerns, the company losing access to their auditor, the auditor dropping SMCI, but they say an investigation did find no evidence of fraud, and we've also seen a huge run-up in the stock, of course, following their announcement that they are expecting $40 billion in revenue for 2026, but that volatile story still continuing.
Yeah, a lot of it just hinges on whether or not, I mean, again, you can only take what they have said at face value. They said that they are going to meet this deadline as of today. The fact that the clock is ticking, obviously, the shares are off and under a bit of pressure here, off just about 8%. Again, when you go back to the guidance that we did get earlier this month, that long-term revenue outlook, the fact that they did pledge to once again meet that NASDAQ deadline, that did alleviate some of those concerns. You can see it reflected in the share price to the right-hand side of the screen right now. But again, still lots of questions about whether or not, one, they are going to meet this deadline, but then two, just beyond that, fundamentals of the business. Obviously, there's a lot of outstanding questions there as well.
Lots of questions.
Let's take a look at Tesla. Tesla's market cap falling just below the $1 trillion market. Shares do face some pressure, which comes as its European sales hit a 2-year low. You're looking at today's drop of just about 7%. So talk about the significance of this. We certainly have seen this risk-off sentiment. Many of these Mag 7 companies have been caught up in some of that selling pressure here. You're looking at Tesla here lead to the downside. It's actually the biggest laggard in the index during the drawdown that we have seen from the December high level. So again, we have seen this continuation of selling here right now, falling below that $1 trillion market cap. Lots of questions about what it's going to take in order to reverse some of that momentum, obviously beyond just Tesla, beyond and into some of those larger tech giants and some of the more broader selling that we have been seeing. But again, Tesla under a bit of pressure, of course, putting into context after the massive run-up that we saw following the election.
Yeah, that's a really great point, though. Tesla being the loss leader today does officially put the Magnificent Seven into correction territory as of this morning. And a reminder, correction territory is when a stock or an ETF, an index, is down by 10%. So that's what's happening with the Mag 7 ETF right now. But the big question, I think, is how much of this is due to Elon Musk's politics impacting his sales in Europe. I think it's interesting context. They had a 1% market share in Europe in January. That was down from just 1.8% this month last year. So not that huge of a drop off, but when you compare it to some competitors, especially the Chinese EV giants, they had a lot of success in January. So it points to this kind of comparison game and whether or not the competitors are able to take up more market share given Musk's continued focus on some far-right politicians in Europe. And maybe that is starting to weigh on those sales. Again, BYD in particular outselling Tesla in the UK for the first time ever for the month of January here. Well, AI heavyweight Nvidia is set to report results after the close on Wednesday. For those thinking of buying the stock before earnings, we've got to look at what your return could look like based on past performance. Here with the breakdown, markets and data editor and host of Stocks in Translation, Jared Blikre. Hey, Jared.
Hey, Maddie. Well, we've been talking about the breakdown in the Mag 7, and let's talk about the poster child, Nvidia, down 10% for the year, and we are just showing a year-to-date chart. This is frustrating for traders, but we've seen this before, and a lot of times the earnings has been a catalyst for both the bulls and the bears. So let's break down the earnings reactions over time. I'm going to go back 10 years here, and I'm looking at the average and median returns of various time frames after the report. So here is one day. You can see a median result of 3.4% to the upside. For 1 week later, it's a median of 4.3%, and for 1 month, pretty much sticking within this range, also 3.4%. And you can see the percentage positive going pretty sideways as well, 63, 68, 60. Anything less than a 70, I don't really think is too bullish, just because US stocks tend to go up. But it gets interesting. 1 quarter out, we see the average or median returns up 17.5%, and then the percent positive goes up to 74%. But the real magic happens if you're holding for a longer period of time. 1 year returns tend to be 112%. That is a huge amount, basically doubling over a year. And this goes back 10 years, let's remember. And then the percentage positive shoots up to 84%. Very strong results there. But I've seen many times over the last few years, especially within the pandemic or post-pandemic, the tendency has been, and there's been a few examples of this, for the earnings reaction to be suddenly reversed. So there have been times when it jumps up to a new high. The next day, everybody gets excited, loads up even more, and then it only crashes down. So I think that dynamic is kind of what we're looking at right here. So the message for traders is probably want to be a long-term holder unless you're extremely adept at navigating these short-term vicissitudes. Now, I want to get into the weeds a little bit by looking at options implied volatility. This is a very simple concept. Measures investors' expectations of future price swings based on options prices. So we look at the options market, and those traders' opinions are being reflected in that, and we come up with some numbers here. The options implied volatility for the 1 day after the announcement is 8.5%. Now, the prior 2.5-year average here in the actual reaction was a bit higher, 11.1%. So options traders are not expecting as big a reaction actually as we have seen historically, just based on this metric. And then we have the average daily movement since the last earnings, excluding that earnings day. So if you take out the big day after earnings reaction, you only see volatility of about 4.3%. So the bottom line is we can expect a doubling or even a tripling. That would be nothing. That would be no sweat for Nvidia on Thursday. And that's the earnings reaction day that we want to pay attention to. So you wrap it all up. We have something for the short-term traders and the long-term traders here, but the long-term traders definitely have it a lot easier, at least with respect to Nvidia.
All right, Jared, thanks so much. And of course, we're going to have coverage of the every move that we're seeing in the stock's reaction following those results on Wednesday after the bell. And then, of course, with us as we kick off our opening bell coverage on Thursday morning. Jared, thanks. Coming up, crypto sentiment sinking, Bitcoin hitting its lowest level in about 3 months. What's next for the crypto industry? That's coming up when we come back.
And I think we're happy to put that behind us. I think that there's so much to be built that at the end of the day, we'd rather not engage in litigation, particularly when we think that it's not well-founded and not based on anything real and just a general kind of attack on the industry.
Bitcoin falling below $90,000, hitting its lowest level since November. This comes after hackers drained $1.5 billion in digital assets from the exchange Bybit, and what researchers are dubbing the largest crypto hack of all time. Joining us now to discuss, Noel Aitchison, Crypto is Macro Now founder and author. Noel, thank you for being here. So how much of this is about the Bybit hack versus general macro concerns driving the sell-off?
It's easy to guess, it's easy to assume that this is the delayed reaction to the Bybit hack, but I don't think so. The Bybit hack was awful, but it was handled really well. And what's more, by Monday morning, the hole had been filled. Over the weekend, the industry showed that it is maturing, that it is transparent, and that it can come together in times of crisis. Not to belittle what happened, it was awful, but I think it was very much isolated to the crypto community and it was digested. I think what we're seeing now in the crypto markets is an extension of what we're seeing in macro markets. We're heading into risk-off territory, and crypto, being high beta assets, are reflecting that and then some.
So then, Noelle, what does that then tell us just about some of that downside maybe that we could still see here in the move with crypto?
Crypto is going to be slightly more volatile than traditional assets, but it could go lower. To be honest, this is something we've sort of been expecting. Crypto, I'll take Bitcoin as the bellwether here. It has been trading more or less sideways since the November rally. And so we've all been waiting, is it going to break up or is it going to break down? It has to break in some direction at some time. And given the clouds gathering on the macro horizon, growing consensus was it was going to break down at some stage. When? We didn't know. Maybe that's what we're seeing now. But what we're seeing is not just growing concern about U.S. economic growth. I mean, that's pushing bond yields down. That's pushing the DXY down. That should be good for risk assets, all else equal. But we're also seeing concerns about geopolitical fractures. And let's face it, the Trump rally could be just getting exhausted here. It could be some fatigue we're seeing setting in. I mean, let's face it, the past few weeks have been exhausting. Add to that, throw in some skepticism that the Doge cuts will actually make a dent in the deficit. And things feel particularly fragile now. So when you are talking about assets that can behave either as risk assets or safe havens, depending on the mood, then everything that can be sold will be sold.
So Noelle, I guess that begs the question, is there anything on the horizon that's going to change then this downward momentum?
Yes, then I would say that's simply price. We know that, and this is one of the advantages that an asset such as Bitcoin, again, to pick the bellwether crypto asset, is one of the advantages of its multi-narrative characteristics. It is a risk asset, and so we'll head down with other risk assets when that's the mood, but it is also a safe haven. It is very much like digital gold. This is a narrative that BlackRock and many others have been pushing out there, and many investors do see it as that. So when it gets to a lower price, those that have been sitting on the sidelines waiting for opportunity will step in. Its floor is going to be higher than other assets that didn't have that diversity of narratives. And let's face it, if ever a safe haven was needed in diversified portfolios, arguably it would be now.
So basically, an unknown low level is going to be the next catalyst for upside momentum in digital assets?
True. And when I say unknown, I'm not a technical analyst, but many of my colleagues in the industry are. And because it is a sentiment-based move generally, they do tend to hold some weight. And 80 is the next number that people are talking about. It could go that low. But again, we don't really know, because all it would take is for the selling to get exhausted. I'm often asked, Maddie, whether, what's the catalyst? What are we waiting for to get the bull market going again? And the answer is always when the sellers get exhausted. And often what it takes for that to happen is a short, sharp correction like this. It's a thin market. When things are moving fast, people do tend to, step back and let the liquidity providers do what they're going to do and let the short-term traders do what they're going to do. But this will find a floor eventually. I have no idea how low it'll go, but I would bet not as low as many would fear.
And it's interesting in the context of this administration, which of course has been viewed as very pro-crypto, and we've seen the SEC dropping their lawsuits against Coinbase and Robinhood in recent weeks. I was a little bit surprised that those events weren't a bigger catalyst for Bitcoin to the upside. Can you walk me through that?
Absolutely. You raise a really good point. The tailwinds for crypto markets have been building. So many of its obstacles have been being removed. So everything has been setting up the crypto asset, especially the prices of the bellwethers, for a very positive run that hasn't been happening, which has led many to say, is this over? The mood has been bleak in the crypto market recently, and partly it's because we haven't been getting the rally that we expected with the regulatory thaw. But I do believe that is because we're not yet seeing the new money come in. And we all know that bull runs are always driven by new money coming in. The new money we're waiting for is from the large institutions who are having the path cleared for them to do so, with the large custodians gearing up to offer services, with the ETFs already on board. However, they take their time. They're not necessarily going to be moved by short-term considerations. They have a lot of boxes to check, a lot of people to convince. And a drop like this could incentivize them to start to come in, but they were always going to be slow but methodical skeptical and careful. When we do see them come in, then we will see the move. Until then, the headlines that we're getting, the positive move, the positive noise from Washington, D.C., that is just building the tailwinds. It's not necessarily going to move the price until the new money does start to step in.
Yeah, that makes a lot of sense. So I hear you noting that it's this digital safe haven, but also a risky asset. Help our investors understand how they should be strategically thinking about portfolio allocation when it comes to crypto, given that it holds both those titles, a safe haven and a risk asset.
That is such an excellent question, and it also highlights how confusing this asset group can be to many people. I often get asked, what is Bitcoin? And my answer is it's what you want it to be. If you want it to be a risk asset, then it's a risk asset for you, and you will trade it as such. If you want it to be a long-term holding, a safe haven, a diversifier, much like digital gold, then that's what it will be for your portfolio as well. In the end, it comes down to timeframes. If you're thinking short-term, crypto is volatile. How can such a volatile asset be a safe haven? Long term, it is, because it resists the dilution that we're seeing in most others. So that's the easy answer. It can be both according to different timeframes, and that adds a certain fascinating complexity to the narrative behind it. It gives it a higher floor than other assets, and it also leads to some very interesting philosophical questions. How can an asset be so many different things at the same time?
All right, Noelle, always great to talk to you. Thanks so much for making the time to join us.
Thank you so much.
Well, the selling continuing today in the broader market. You've got the S&P extending its decline, hitting the lowest level that we've seen since January 15th. Now, despite the drop and the recent move to the downside that we've seen, some on Wall Street seeing a few catalysts on the horizon. Here with more is Yahoo Finance's Alexandra Canal. Ali, give us some reasons to be optimistic.
Yeah, it's a lot of pessimism on Wall Street right now after this consumer confidence reading. We had the sentiment reading on Friday, but there are some catalysts, especially in the near term, that could drive stocks higher. And if we think about the sell-off that we saw last week, there was a confluence of different factors there. We saw Walmart's soft guidance that led to some concerns about the state of the U.S. consumer. We had Microsoft's decision to cancel some leases for data center capacity. But as we look in the week ahead, Nvidia earnings on Wednesday, that's something to look forward to, especially since a lot of those big tech names, in particular the Mag 7 names, they've underperformed the broader market here. Now, most on Wall Street do expect Nvidia to outperform this earnings. The options market, it's implying a 7% gain or loss. That's significantly less than what we've seen over the past 2 years, but it remains to be seen. If we get solid results from Nvidia, that's likely to make the Mag 7 enjoy some gains. So perhaps the Lag 7 can now be the Mag 7 once again. There's also the fact that we have this expectation that inflation is going to continue this deceleration. We did have that hot CPI print, but there were components within that consumer price index that feed into the PCE inflation data. That's the Fed's preferred inflation measure. And that actually showed some softness there. So, and if we get that better than expected inflation report on Friday, another potential boon to stocks. And then finally, the Fed outlook. Yes, we have these risk factors that have been wandering around the market, and perhaps that convinces the Fed to cut rates sooner rather than later. We see that the odds for a May cut, that's actually doubled over the past few weeks. We're still at a pretty low level, just around 20-25%. But if we get a further deterioration of the labor market, if we see that GDP data that's due on Thursday come in a little softer than expected, perhaps the Fed can recalibrate its rate cut thinking. And obviously markets would love to see some rate cuts at some point this year. We did hear from Bank of America earlier today saying that they don't anticipate any rate cuts in 2025 or into early next year, but we just don't know. And all of that could be a potential tailwind for some of these market moves.
And it's really interesting given there was so much optimism about the incoming administration and the market rally that would come off the back of that. And then you had Michael Hartnett from Bank of America this morning saying that the market still is a red light for the Trump administration. I wonder, Ali, when you think about the conversations you have with sources and just your outlook for the market this year, how much momentum and optimism do we have? How much potential do we have to move to the upside given all the question marks about policy right now?
Well, look, markets don't like uncertainty. And I think in particular, when we think about the tariff conversation, we just don't know. I mean, Trump has gone back and forth when it comes to those tariffs on Canada and Mexico. He revived those threats the other day, which is part of the reason why we're seeing some markets sell off. But by and large, Wall Street analysts do see upside ahead. Citi sees the S&P ending the year at 6,500. That implies upside of about 10% 10% based on current levels. So they have warned that between now and then, there's going to be some choppiness. There's going to be some volatility. You have to be patient within this market, especially since we do have valuations that are so high. And Hartnett was also talking about the fact that we're seeing a lot of inflows into overseas markets and how that could potentially signal some trouble ahead in the U.S. But it seems like by and large, Wall Street is still bullish on the long-term outlook for stocks. You just have to be able to weather some of that volatility in the interim, which we know investors don't always like it, especially when we've been used to such massive gains the past 2 years of this bull market.
Yeah, exactly. Those double-digit gains getting us very spoiled, Allie. Thank you so much for joining us and breaking that down. We appreciate it. Coming up, Apple preparing for shareholder meeting showdown over its DEI policies. We'll have the details for you next.
Apple investors are set for a decisive vote at the company's shareholder meeting today with DEI on the agenda. Here with the details, senior legal reporter Alexis Keenan. Alexis, what can we expect later today?
Yeah, so at about 11 o'clock Eastern time, the shareholders meeting will get underway, at which we're expecting this proposal to get a vote. And it's a proposal from a conservative think tank called the National Center for Public Policy Research that has been pushing for some changes to DEI efforts across U.S. corporations. And what they're asking here for from Apple is to consider abolishing its DEI efforts, so diversity, equity, and inclusion efforts. Apple is opposed to this measure. The shareholders, for their part, what they're claiming is that DEI now in 2025 and also in 2024 too, arguably, poses financial risks, legal risks, also reputational risks to companies. Why? Because in 2023, there was a Supreme Court decision that outlawed using race as a factor in university admission decisions. On top of that, you had another Supreme Court case that has made it in 2024 easier for employees to go after their employers to sue them for discrimination claims. So those two things, these shareholders say, walking into Apple and saying, well, we need to vote on this, we need to reconsider. And that's what is happening across corporate America. A lot of these pushes to end these DEI initiatives. So on top of that, you also had an executive order from President Trump on his first day in office saying that he wants to end the federal DEI initiatives, also warning private businesses that they should end what he called illegal DEI efforts. And especially for federal contractors, that kind of raises a flag for them, and Apple is a federal contractor. And the reason is because federal contractors have to do a certification that they don't have any illegal DEI efforts ongoing within their walls. So a lot to consider. The same think tank also submitted anti-DEI proposals at JP Morgan, also at Goldman Sachs as well.
How is this impacting those other companies then, especially when you consider what you were saying about those federal contracts? Are there other companies you've been tracking that have significant federal contracts that could make them, I guess, more susceptible to any shifts from the Trump administration on DEI changes?
So there's a legal argument ongoing as to whether the executive order, whether any of this really plays into the private sector, right? There are plenty of attorneys who will get up and argue, well, no, none of this impacts private enterprise. They can do what they want, make their own decisions on diversity, equity, and inclusion. But we have at Yahoo Finance been trying to track some of these companies. You can see there on your screen, you have a lot of companies that are going ahead and putting in their heels, sticking with their initiatives, Apple, Coke, Microsoft, Costco, to name some there. You see Delta also. And then on the other hand, the companies that are pivoting, that are shying away from their DEI programs, Google, Meta, Goldman Sachs, Citigroup, Target, Walmart, Amazon, there are more. You can check it out online. We've been trying to track these changes as closely as possible.
All right, Alexis, well, thank you for your reporting on that, and we will continue to monitor what happens with this Apple meeting later today and talk to you about that as well. Thank you. Coming up, we're talking with the CFO of Amer Sports about tariffs and the health of the consumer. That conversation next. Shares of Amer Sports, parent company of Arc'teryx and Wilson, are under some pressure this morning after the company reported its latest results. The company expecting unfavorable exchange rates to weigh on sales growth in 2025. Joining us now, Andrew Page, Amer Sports Chief Financial Officer. Andrew, great to have you on here. So lower sales growth and the revenue growth outlook for 2025 are weaker than expected. What do you think is driving that pressure?
As you talk about 2025, I think about 2024. We had an amazing year. We exited 2024 with really, really strong sales growth, up 18%, paid off about $2.5 billion of revenue, strengthened our balance sheet, reduced our effective tax rate, reduced our leverage ratio, and then exited 2024 with momentum. As you think about the underlying business next year, our guide, which speaks to reported currency on a constant currency basis, would reflect about a 15 to 19% growth on a constant currency base. So exiting 2024, the business is strong. Entering 2025 is healthy, and our constant currency growth rate is in line with 2024.
Andrew, are you starting to see any sort of weakening trends, though, within the U.S.? And I just bring that up because the growth numbers that you posted in the Greater China region were staggering, just across Asia Pacific in general. And then you compare it to what we saw in the Americas, where it did grow 15%, but that pales in comparison to some of those growth rates that you're seeing overseas. I guess, what do you attribute that to?
I attribute it to the maturity of the market. So we have been, Wilson, which is a predominantly U.S.-based business, has been doing business for 114 years. Arc'teryx, Solomon, they are just entering in the last 5 years some of those markets where you see the outstanding growth rates. And so as those markets mature, they started from a much smaller base, and we're excited about the growth across all of our markets. You mentioned the growth in APAC and Greater China approaching 50%, and in the Americas and EMEA, really strong growth as well. And so as our markets mature, we like the fact that we have a very global distribution of revenue. We operate across all 4 of those major markets, and we're excited about where the business is growing and the even distribution of our revenue.
I hear you saying you're excited about the globalization of the business, and I think that's interesting in the context of tariff policies that a lot of the executives we speak with are concerned about for 2025. How are you positioning and strategically thinking about the potential impact of tariffs on your business?
Well, I think about the fact that because of the global nature of our business, we are about a third from a revenue distribution between North America, EMEA, and Asia. And that is a benefit to us. We benefit from having a distributed revenue base. As a result of that, we also have a number of levers that we can pull because of our premium positioning of our products. We obviously have pricing power. We have a diversified sourcing base, which we can pull from and resource if necessary. And we have strong relationships with our sourcing partners that will allow us to do some cost sharing should tariffs arise. So we have a number of levers that we can pull.
So, Andrew, do you see any sort of impact potentially to your bottom line because of that?
Well, obviously our 2025 guidance contemplates what we can control, and that is producing great product, continuing to delight our consumer, and continuing to innovate. Obviously, we balance it with the known risks of the macro, of which I called out a couple of things on our call with regard to FX headwinds as we head into 2025 with regard to the reported growth rate. But the underlying business is really strong. The consumer continues to reflect resilient. Like I said, from a tariff perspective, should they arise, we have a number of levers that we can pull.
So, Andrew, I guess given the fact that the consumer is so resilient, do you not see then the need to rely maybe on discounting so much then this year?
Yeah, I think that the strategy of discounting as a strategy for us, we are a premium product company, and we do stay away from discounting. Obviously, we'll continue to price our products in the market, and they will reflect the value to the consumer. We don't see discounting as a primary lever that we intend to use.
And I heard you mentioning pricing power. Do you anticipate, and have you already started conversations around raising prices on any items?
Well, pricing power is one of the levers, one of the 3 levers I talked about. We have pricing power. We also have the ability to resource as necessary, and we have strong relationships with our vendors whereby if tariffs do arise, the opportunity to share some of their costs with our suppliers is one. And so what we're doing is we're controlling the things that we can control. making great products, delighting our consumers, continuing to put innovation in our products, and we are well positioned should tariffs arise to be able to navigate what comes.
Andrew, have you seen any change just in terms of consumer behavior? And I understand that the consumer remains very resilient, but just in terms of what they are buying, what they're not buying, and maybe what you're seeing just across differences here across your various brands.
Yeah, we obviously participate in the consumer discretionary sector, and as a consumer, they will continue to vote with their wallet. And one of the things that we benefit from is we are in a space, the outdoor space, where consumers have continued to prioritize their health, their welfare, their both mental and physical health, and we provide products that sit square in the center of the bullseye of what consumers are actually desiring.
All right, Andrew Page, always great to get some insight from you. Thanks so much for taking the time to join us, CFO of Amer Sports.
It's a pleasure. Thank you very much.
Let's do a quick check of the markets here. Just about 90 minutes into the trading day, you're looking at right around the lows of the session. You now have the S&P off, just off the lows of the session, actually. You got the S&P off about 0.9%, the Nasdaq off about 1.5%. We did see the lowest level for the S&P since mid-January. You do have the Dow barely holding on to gains up just about 0.2%. That does it for Catalyst, but coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned.